Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Well, it's April the 17th. The Q1 earnings season kicks into full gear this week. Shiraz Mian here with me to give us some initial thoughts on what might be going on during this brand new reporting season. Street looking for the best profit and revenue growth since 2011. What do you say?
The earnings growth is not really going as back as 2011. We have, in our numbers are a little bit different from other data vendors, but the revenue growth definitely does go back to 2011, 2012. We're looking for about 7.6% earnings growth as a whole for the S&P 500 in Q1, and about 6% revenue growth. That'll be an improvement over what we saw in Q4, which was the best earnings growth in 2 years. Typically, actual growth comes in 2 to 3 percentage points better than what is expected at this stage of the reporting cycle. So I wouldn't be surprised if we do end up in double digits by the time all is said and done.
And at this point in the reporting cycle, since we're just getting started, the banks are the first to report.
That's right.
So in this morning's earnings preview that you wrote, you noted tepid loan demand among the bigger banks. Is that worrisome to you?
It is. JP Morgan CEO went out of his way to reassure not to read too much into it. It wasn't totally a surprise because the Fed quarterly report, which compiles this loan data, we knew already that growth in Q1 had decelerated from what we saw last quarter of 2016 and the third quarter of 2016. So there's a number of explanations. Personally, to me, they don't make a lot of sense. There is a seasonal slowdown that we see in Q1 consistently over the last many years. Perhaps it's that. Perhaps it is the explanations that the banks are offering, which are a combination of things like the capital markets were very strong, so companies and businesses didn't really need to go to banks to borrow that much. The auto sector is a little bit cooling off, so not that much on that front. Mortgage rates have gone up, so mortgage loans are a little bit cooling off. On balance, with the big guys, the JP Morgans, the Citigroup, the Wells Fargos of the world, not so much with Wells Fargo, but definitely JP Morgan, Citi, and Bank of America, they have diversified businesses, so even though there was weakness on the loan demand side, they were able to offset that from investment banking and trading. The regional banks that are reporting this week, they don't really have that luxury. So if they experience equivalent deceleration in loan, it could be problematic for them.
All right. So at this point, is there even a scorecard to look at yet?
It's not really much, but I do have a slide I want to show. I'm going to share here with folks. We have 31 S&P 500 companies have reported results already, heavily weighted towards finance, as you pointed out. 10.2% earnings growth on 4.2% revenue growth for these 31 companies. I've shown the comparison here for the earnings and revenue growth rate relative to what we saw from the same group of 31 companies in the preceding quarter, then the 4-quarter average and the 12-quarter average. So the growth rate, earnings and revenue, is tracking better than we have seen in the recent past. The other slide is the beat percentages, so the proportion of companies beating earnings and revenue estimates, and that is tracking better than before too. So it's a small sample, not really representative of the index as a whole, but so far so good would be the takeaway. A brief touch on the finance sector, which, as you pointed out, is heavily represented in the sample at this stage. About 22.1% of the sector's market cap in the S&P 500 has reported results already. 10.8% earnings growth and 3.1% revenue growth. all of them that have reported thus far have beat estimates, EPS estimates. 60% are beating revenue estimates. And as with the index as a whole, the finance results are tracking better than before as well. So early, we'll need to wait a little bit more. By the end of this week, we'll have a better representative sample of results. But as of this stage, pretty good.
Well, there have been some news events, or some events that got reported in the news for individual companies, which might, going forward beyond Q1, take a toll on corporate earnings. The best example is the United incident that has already caused a hit to the stock price in a big way. But that said, do you see standout performers among individual companies, either on the positive or the negative side for Q1?
I do. On the positive side, and I have a summary picture that I would show here so that folks could take a look at it. On the positive side, finance as a whole, technology as a whole, they should, both these sectors, and these are two of the largest in the S&P 500, both should come out with double-digit earnings results. We saw JP Morgan, Citi, Wells Fargo, we have Bank of America and the investment banks coming out this week. All of them should come out with very strong results. The regional banks, there is a bit of a question mark over their outlook. But on the whole, finance appears to be on track to have another quarter of strong earnings growth. Same is the case with technology. Even though Apple has kind of flattish expectations, the sector as a whole is expected to do better. On the negative side, you mentioned United Continental transportation sector, 21.4% lower earnings this quarter versus the same period last year.
Driven by that one company, you think?
Driven by the airlines as a whole.
I see.
And the revenue picture for airlines isn't bad. There's positive growth, but it's the line items in the income statement. There's personnel expenses, there's jet fuel, there's a bunch of other items which is weighing on their margin. So whether it's American, United Continental, Alaska, all of them have positive top-line growth, but the bottom line comparisons are tough for these guys. The other two areas, two industries in transportation as a whole, railroads and the trucking, they are doing fine. They have more exposure and leverage to the domestic economic outlook, and that those have been doing better. Energy should do better. We had a modestly negative read from energy this time last year. So the comparison I've shown NA in this table, but that's because the growth rate is hard to calculate when you're moving from a negative to a positive. They had about $1.5 billion in losses Q1 16, and the sector is expected to report $8.5 billion in positive earnings. So that should stand out as well.
All right. Well, the Q1 results being overall good were pretty much expected. Now,
that's fair.
What's more important, the Q1 results or the Q2 guidance?
The Q2 guidance is more important always. If a company comes out with bad results for the quarter that's behind them and offers positive outlook for the current and coming periods, investors typically will reward that stock. If you have a positive results for Q1 and also offer a positive outlook for the current period, you get more rewarded. So the outlook is always in the earnings context, in the stock price context, far more important than what has happened in the rear view mirror. Guidance absolutely matters.
So let me be a little more specific.
Sure.
Then. The Q2 guidance that we have for the next quarter, or that'll be coming up for the next quarter, is there a reason to believe that it could be problematic?
Well, let me share this slide here, which shows actual growth the last few quarters and then expectations for the coming quarters. So you would see that 7.6% is the earnings growth for Q1, and then 7.5% is expected the earnings growth for Q2. Now, the typical standard and trend over the last many years has been that as these companies report Q1 results, they would guide lower for Q2, and estimates for Q2 will come down. That's been a persistent trend we've been seeing for the last many, many years. It has been moderating to some extent over the last couple of quarters, meaning that estimates are coming down, but not coming down as much. We would like to see continuation of that trend in this earnings season, which means that the 7.5% growth rate expected for Q2, it will come down. The expectation and the hope will be that it doesn't come down as much as we would typically see like 4 to 6 quarters back. So it is important to watch what happens to estimates for Q2.
All right, and I know you'll be watching for
Absolutely.
sure. And besides these video conversations that Shiraz and I have, he will be noting any changes in his thinking in his written commentaries, earnings previews on Monday, and then periodic earnings outlook commentaries throughout earnings season. And you can access those right on our website, Zacks.com, right off the home page. All you need to do is go there first, scroll down till you see his picture, and they'll all be there for you. With Shiraz, I'm Terry Ruffalo.